When an established financial market structure collapses, asset prices fall rapidly, and absolute panic sets in across the board. In the Wyckoff methodology, this sequence marks the beginning of Phase A. This is the transition where the aggressive momentum of a downtrend begins to face institutional absorption. Retail traders watch this drop, read the terrifying news, and capitulate. Institutional funds watch the exact same drop and test the market to see if the downward selling pressure is finally exhausted. Today, we are going to look at the transition from a trend to a trading range. We'll map this violent chop and use it to generate predictable income by deploying short-duration options. Spotting the exact moment a market transitions from a trend to a trading range tells an options trader when to stop betting on direction and start getting paid to wait. Step 1 is establishing our baseline, an intact, aggressive market downtrend. The price is making lower lows and lower highs continuously. Look at this line chart. The price is falling, but the rate of decline begins to slow. Wyckoff's preliminary support. It's a strict risk reduction signal. Cover shorts, halt new shorts, do not buy yet. Next comes the emotional puke. The crowd capitulates in forced liquidation, printing a massive extended down bar, the selling climax. Notice the extreme volume spike matching the climax. Smart money is actively absorbing the panic selling. Institutional funds require immense liquidity to build positions. They rely on forced retail liquidation to safely absorb millions of shares without immediately driving prices lower. During a selling climax, fear drives up the price of insurance. Implied volatility spikes massively, making put premiums severely overpriced. This chart displays the payoff profile of a put credit spread, our preferred strategy for peak volatility. You execute this by selling a put near the extreme crash low and buying a further out-of-the-money put to define your risk. Keep the duration tight, ideally 7 to 21 days to expiration. This structure provides a triple edge. You capture profit if the price bounces up, chops sideways, or if implied volatility simply crushes after the panic. By selling volatility during peak panic, you completely remove the need to perfectly time the absolute bottom of a market crash. Once the sellers are flushed out, supply temporarily disappears. This creates an automatic rally, a mechanical, low-volume bounce. This candlestick chart traces that relief rally. Once the price stalls, it formally defines the top boundary of our new trading range. At this line, take profits on your initial panic trades. The market then drifts down to revisit crash lows. This secondary test probes for remaining supply. Validate it by checking 3 items: price returns near the low, candle spread is smaller, and volume is significantly lower than the initial spike. Verifying this low volume test confirms that the selling pressure has been absorbed. The trend has halted, and the market is now contained within a trading range. Now that we have a confirmed, defined range, we deploy the primary Phase A income strategy, the Iron Condor. This diagram demonstrates how the Iron Condor perfectly fits the market structure. We use the rally high and climax low to define borders. Sell an out-of-the-money call spread above the top line and an out-of-the-money put spread below the bottom. Target a 30 to 60-day expiration. Set a hard rule for risk management. Place your stop losses slightly below the climax low in case the structure fails. By deploying this bilateral structure, you are capturing the erosion of option value while the market exhausts its remaining momentum inside the range boundaries. Impatient traders routinely mistake the selling climax for the start of a new bull market or try to call the ultimate bottom too early. When they attempt to force a directional breakout inside a newly formed range, their momentum is violently rejected. Do not buy long-dated calls or directional leaps during this phase. The extended sideways chop will drain the value through theta decay. Phase A is a trap designed to grind down trend followers. It strictly rewards traders who possess the discipline to pivot to mean reversion tactics. The execution sequence is strict. 1. Spot the extreme panic. 2. Sell put spreads into the volatility spike. 3. Confirm the low-volume secondary test. 4. Deploy Iron Condors on the confirmed borders. Surviving the chop and systematically extracting premium during Phase A is simply laying the groundwork. This preparation stages you for Wyckoff Phase C, the spring. That is where we leave the income strategies behind and position for massive asymmetric directional trades. Mastering Phase A provides a specific framework for high volatility environments, converting market exhaustion into a structured system for generating options premium.